We are live.
All right, sounds good. Welcome, everybody, as we start to compile all of our attendees. Thanks for joining. We'll be getting started here in just a few minutes. All right. Getting a few folks popping in there, Jeremy.
We do. People are coming in left and right.
All right, great. That's great. Welcome, everybody, as you're getting signed in, whether you're on Facebook or whether you are attending our webinar version of this. Either way, you can hear us and see us. So thanks for being here today. We're going to get started here in just a couple of minutes, but logistically, we want to make sure that everybody can kind of hear and see everything and recognize that a big part of this, of course, a big benefit of you attending live is the fact that you get to ask questions. And that's a big part of this, right? Because it's going to guide our discussion. We could really give this presentation every week and we'd have a little bit different stuff to talk about, even though we put together the slide deck here at the end of December. Really, there's a lot that's changing really every day, every week. So based on the questions that you ask, that might guide a little bit more of what we talk about. So definitely make sure that you're using the chat questions feature. And we are going to be recording this as well. So anybody who wants to come back and watch the replay certainly can do that. We always recommend that you pass this along to anybody that you think it would be useful for. So just glad that you're here and thanks for joining in today.
And as a reminder, as everybody logs in and gets going, as questions come up, there's a Q&A function on the bottom of your screen. You can feel free to jump into that and ask any questions that you do have. And we will tackle them as we can, if not at the end.
All right, we'll give people about another minute or so to get signed in. But for those of you who are popping in here, I think we're seeing lots of people joining us. So thanks for being here live. It's always fun to have people here live as opposed to just recording stuff. We're always grateful for people who come back and watch on YouTube or watch it in their feed on Facebook as well. So however you're listening to this, that's great. But for those of you who are here live, thanks for joining us. We gave the in-person version of this here last month, actually just a couple of weeks ago. So it's kind of interesting. We have even more different stuff to talk about, updates now. So it'll be interesting to unpack that with you over the next hour or so. And as we're coming up on the 11:30 mark, at least 11:30 Mountain Time, make sure that you have located the Q&A feature because Jeremy's going to be, excuse me, Jeremy's going to be moderating that. And we want to make sure that we keep this interactive. We want to answer questions along the way, but we'll certainly take lots of questions at the end. We'll have time for that. And we'll be watching our time here.
Definitely filling up quickly here.
All right, great. And thanks for everybody joining us. These have been fun, really, to do webinars. I think we've done webinars before, but it's became a necessity, of course, in the COVID era that we're in right now. So definitely appreciate the fact that everybody's tuning in from around the country. We'll get going here. So forecast 2022. Today, we are going to talk about the pandemic recovery, which continues to go, right? This is something that, I think is going to play itself out over years, not just months or quarters like we once hoped. This has really had a pretty far-reaching impact on the global economy. And it's not all bad, right? There have been some things that have come from it that have been good. And I think a lot of companies, a lot of families even certainly have had some tragic things that have happened, some bad things that have happened as a result of the pandemic, but also lots of good stuff that's happened too that we can be grateful for. And here at Keystone, again, we've I think we've always used education. We've always used technology to be able to communicate with our clients where they're around the country and different states, going warm places for the winter, whether people just can't get out for the day and want to tune in from their workplace. We want to make sure that this is available to you and your friends and coworkers, and the replay is available as well afterwards. So before we get going here, we always like to warm up our brains a little bit. And so the first thing we're going to do is talk about disclosures. It's everybody's favorite. This is what our attorneys wrote. So just understand everything we talk about today is just Jeremy and I and our opinions. Obviously, nobody knows. The Fed chairman, the president, it doesn't matter who you talk about. Nobody really knows the future, knows where things are going. So these are just our opinions and our observations based off of our conversations with clients and also just looking at what the other experts are saying. So with that agenda, the economy, financial markets, and what may be ahead. These are the three main sections that we always like to cover. And before we do that, we're going to warm up our brains with a little bit of a quiz.
There we go.
So the first one here is that a customer in North Carolina liked a certain, these are all true, by the way. So a customer in North Carolina liked a certain type of cuisine so much that they ordered from the same restaurant 904 times. That's 2.5 orders per day in 2021. This person must be pretty wealthy to be able to afford this. What type of cuisine was it? Any guesses? Any guesses? Again, feel free to use the Q&A feature out there. This is from Uber Eats, by the way. I think we've all gotten accustomed to Uber Eats or DoorDash or something like that the last couple of years, right? And the answer is Indian food, believe it or not. And again, this person must either be really wealthy, have a really high income, or they're probably really poor because they spent all their money on Uber Eats the last couple of years. Second one is customers sometimes had odd requests. Again, this is a survey done by Uber Eats. Which of the following food combinations was not actually requested during 2021? Was it watermelon and yellow mustard, ice cream and hot sauce, pizza and sauerkraut, or French fries and hot fudge? These all sound a little bit weird to me.
Yeah, I don't know about any of those really.
Yeah,
Especially mustard on watermelon. That seems a little odd, but
yeah, maybe the pizza and sauerkraut. I like sauerkraut, but yeah, I think the answer is French fries and hot fudge. That one was a little bit odd to me. Again, this is from Uber Eats, our friends over at Uber Eats. Where did people order the healthiest foods? In LA, Miami, Milwaukee, or Portland? We have any good guesses out there? I'm sure everybody's saying Milwaukee, right? I'm from the Midwest, very healthy eaters, right? All of our home cooking back there.
Most everybody's saying Oregon or LA.
Oregon and LA. And the answer is Miami, actually, which kind of makes sense, right? A lot more swimsuit weather down there, especially this time of year. Actually, Florida is surprisingly cold a lot of times. I think it has been recently. And what was the name of the canal where a ship blocked global trade last March? I love this photo, the middle Twitter post. It's kind of interesting. If you notice in there, notice the cotton swab. I don't think that was actually how they got the ship out of there, but it's humorous nonetheless. Anybody have a guess? Any correct answers, Jeremy? Any answers at all?
And we do have one. It's Suez, right?
Suez Canal, and that is correct. We go. Yeah, and I think it's just funny because so many things that seem important on a day-to-day basis, and that actually was right because it was very disruptive of global trade at a time where things have been disrupted anyway. But I think it's interesting to look at some of these things because the stuff that we think is so important on a day-to-day basis, and of course it's the media, right? The media has to talk about something, whatever's kind of new and pressing and can get us all riled up. A lot of times the stuff that they talk about doesn't really come to pass, or it doesn't end up having that big of a long-term consequence. Oftentimes the surprises are the things that we don't expect, that we don't hear about in the news at the moment. And then all of a sudden something kind of comes out of left field. And that was the pandemic, right? The last couple of years. So towards the end of this last year, again, we kind of created the slide deck at the end of December, but much of it's very relevant because it does tell the story as far as the economy and the fact that we've really been in a recession for the last couple of years. And technically, the economy has actually been growing, right? But it's been growing out of a hole. As you can see here on the slide that we prepared, you see these different, the different economic indicators from different countries. Things have actually gotten close to normal at this point, but there's been some disruptions due to COVID, right? So the couple of different viral spreads as this thing is mutated. And overall, Delta and Omicron both have disrupted the world. And we've been in these various stages, right, of kind of opening up and shutting down, and masks or no masks, vaccine or no vaccine. And regardless of what your feelings are about all of these things, I think we'd all agree that this has been disruptive, and it's opened up opportunities as well, but it's been very disruptive as far as the normal order of things. Notably, back in spring of 2020, the fact that to a large extent, the global economy shut down, travel shut down. I don't know if this has ever happened, at least in any of our lifetimes. This has never happened as far as something that's been this disruptive to people's lives and businesses and schools. Really, you think about everything that we do has been disrupted. And sometimes disruption can be a good thing. Sometimes it can force you to think differently and to operate differently and come up with better ways. And I think that's what a lot of companies have found, is that there's been kind of some creative destruction here, right? There's been opportunities that they've been able to uncover to make their businesses more efficient. Others, of course, have suffered and had a tough time with it. So U.S. economic growth, you can see the estimates for the quarter in the fourth quarter anyway, 6.1%. The rest of the year, though, really the economy was growing. But remember, look on the slide here, you can see March of 2020, the economy just fell off of a cliff. And when it fell off of a cliff, it really took a long time to dig out of that, despite all the trillions of dollars that the government has pumped into the economy and central banks around the world. It's not just the U.S. central bank, but central banks around the world have been printing money like crazy. It's worked to an extent, right? It's also created an inflation problem that we're going to talk about, but you can see that we've just barely kind of poked our head above where we had been before. So we'll see what ends up happening here. Again, there could be another outbreak. We don't know what's going to happen with COVID from here on out. We're hopeful that we're entering the endemic stage where things are much more like the annual flu, which normally is an issue anyway, right? Sometimes there's bad flu years and a lot of people end up passing away. It can be bad, but we're hoping that we're shifting into that kind of a mode as compared to what we've seen from COVID the last couple of years. So the Delta variant, again, it really slowed progress. You can see on the graph here, Delta really was much more disruptive, much more deadly. The interesting thing is that they say that Delta was actually 70 times as contagious as the original virus. And then Omicron is actually 140 times as contagious. And so I think we've talked to many of you, of course, clients we talk to all the time. And what we found is that pretty much everybody has kind of been sick with something here recently. It's pretty rare, in other words, that people haven't had a few sniffles. And I think to a large extent, because it is so contagious, regardless of masks or vaccines or distancing, all that stuff, right? Most people have been or will be exposed to this pretty darn quick. So just keep in mind that it's something that we're watching. It's something that certainly could be disruptive, but I don't want to minimize the impact of the pandemic. This is really a pandemic recovery that we're still in at this point. So employment did make steady gains in 2021. These numbers, to update these a little bit, since the preparation of the slide, it was 4.2% unemployment. Now we're down to 3.9% unemployment. And if you talk to just about any business owner that you know right now, their biggest challenge probably is that they can't find enough people. They can't find enough workers to come in and to hire. So that's one thing to just keep in mind, is that a lot of times we talk about these supply chain things, but part of the supply chain issue actually is people, not having enough people. We kind of joke, right, when you can't get your package on time, you joke about, well, it's probably out in, off the coast of Long Beach. Let's row out there and get our stuff, right, our Amazon packages. And we joke about that, but the reality is a lot of it is caused by not enough workers, not enough dock workers, not enough people that are able to pull the trucks up and load them and kind of go off to get supplies to where they need to be. That really is a big part of the supply chain issues that we've been having. As you can see, the percentages vary by men and women and different races and so forth. But overall, that unemployment rate is really, really low right now, to the extent in the U.S. that we're considered at full employment. In other words, most people that want a job can get a job. Now, these numbers never go to zero. Just to be clear, these numbers never go to zero. Full employment is actually considered usually up in the 3, 4, 5% range. Up until the late 90s, full employment was actually considered to be 5%, and now we've gone even lower than that. So what that means is that, again, businesses are having a hard time getting employees. This is something that is going to play itself out and will regardless of the pandemic. The labor force participation that you can see on this slide shows that we're down to 61.8% labor force participation. And the reason why I want to focus on that number is that that's something that's been going down anyway, because really you've got about 10,000 people a day right now in the US turning age 65. That's the baby boom. And you'll continue to have that for some time. That's a lot of people probably about ready to leave the workforce if they haven't already. And the reason why, for many of you, you automatically think Medicare, because Medicare is starting at age 65. Many people wait until that age until they get Medicare benefits before they retire, because it's really, really expensive to go out and buy health insurance on your own when it's completely out of pocket. Medicare usually is much less expensive than whatever it would be that you would get on the open market. So for a lot of people, that is the trigger point. Also, we've seen a couple of other unintended things. The fact that the stock market has done pretty darn well and the real estate market has done pretty darn well the last couple of years. It's actually made people feel, whether they are or not, it's made people feel a lot wealthier and a lot more wanting to retire and kind of move on and do some other stuff. So that's one challenge that we've been having anyway. We were already having it before. If COVID had never happened, we'd still be having this challenge, especially in the US, because we haven't had enough population growth for years and years. We're barely replacing ourselves. So unless we start having a lot more babies really soon, or we allow a lot more immigration, we're going to continue to see a challenge of not enough workers, and not enough workers of the right ages too, right, or of working age. So this will continue to be a challenge, as always, especially in the United States. Oftentimes the solution to any kind of a big problem is technology and innovation. So we'll continue to watch that. Quote here, even before the pandemic, again, we faced an endemic shortage of workers to fill in-demand middle skill jobs. And that's one big factor as well. When we think about the population, oftentimes it's not just having the jobs open, but having people qualified to do them. So keep in mind that there's a big shift right now. And also from a training standpoint, it may not be a 4-year college degree that somebody needs to fill the positions. It could be that if somebody is going to be a plumber, electrician, they just haven't had the proper training, and lots of discussion happening about that right now. Again, we've been having supply chain issues, to say the least. I'm sure everybody has been impacted by that to some degree. During the early stages of COVID, remember toilet paper, right? How toilet paper was in short supply. And that was just one example. A lot of people kind of laughed about it right at the time, but really toilet paper and everything else. When you go to the grocery store, you probably have seen something that looks like the sign. Sorry, these products are currently out of stock, because there's been really a huge interruption in the supply chain, a huge interruption in manufacturers' ability to get products produced. And a lot of times it's just one part. Think about vehicles right now. If you've gone out and tried to buy a new car, driven by a new car lot anytime recently, we've got a dealership just down the street here, and you drive past, there's hardly any new cars on the lot. You can see lots and lots of empty spaces simply because they can't get the inventory in. Lots of demand right now because people have money to buy cars, but there just aren't enough of them. Much of that is because of not just one part, but semiconductors, right? Computer chips that go in vehicles these days. Much of that was disrupted by COVID and really hasn't caught up. The demand has gone up, 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 where you think about pretty much any product that you buy right now has some kind of a semiconductor in it, even things like refrigerators, right? Now they're having to actually go back and retool many of these fancy refrigerators with the computer screens on the front of the fridge doors. A lot of them have to go back and retool and get rid of those things, simply because they can't get the parts. And if they want to be able to sell refrigerators, they can't just not make them forever. So many companies now are having to go back and re-engineer their products to remove technology as opposed to add technology. So this continues to be an issue. It has started to ease up a little bit. Actually, the number of container ships sitting off of Long Beach that I mentioned before, that has gone down quite a bit. So some of these things are starting to work themselves out. But supply chains continue to be disrupted. You don't just shut all that stuff down. As many of you have probably worked in supply chains in your various companies, you don't just restart that, right? It's now taken years. think about the cruise ship industry. Cruises shut down for a while, and it's not just the ships. You're talking about workers that come from all over the world. They all got sent home. In many cases, they couldn't travel to get back out to the ships. So it took some time, not just because of restrictions, but also because of lack of workers. Now, inflation, we're going to talk about a bit here, and many questions come up about inflation. Jeremy is going to cover this a bit more as far as inflation and the Fed. I'd say pretty much every client conversation we have right now, inflation comes up as a topic because it really has impacted a lot of folks. As you can see, inflation has ticked up quite a bit, actually 40-year high. I think we just heard that. It's back to 1982 now that we have to go to see inflation as high as it is right now. So it's something we have not been used to, at least for those of us who, I guess Jeremy and I both existed back then, right? But
yes, we did.
We don't remember. Neither one of us really remember inflation, but we hear lots of people talk about inflation as far as it getting bad and people in lines for gas and things like that. People that were proud of their 15% CD, right? Things like that they were getting. We just haven't seen that for years and years. And there's various reasons for that. But more or less inflation has really ticked up. Best definition of inflation really is just too many dollars chasing too few goods. So that's what we're going to really hammer on here in a second, because that's profoundly going to make a difference as far as where the economy is going and how the Fed reacts to inflation. And as you can see from Mohammed Al-Arian, used to be the manager over at PIMCO and Allianz, one of the largest asset managers in the world, somebody we pay a lot of attention to. He did say recently that the Fed's delayed and slow reaction to inflationary pressures has unfortunately increased the probability that it will have to slam on the brakes. And I think this is where we're getting to, right, as far as what the Fed's going to do by raising rates very quickly after tapering and at a more aggressive pace than it would have if it had started to tighten policy earlier. And that's our view as well, is that this is largely the inflation problem, somewhat supply chain problems, but largely created by the Fed printing trillions of dollars. Although it may have had some benefits, now we're seeing some cost to that as there's too many dollars flying around out there. And again, not enough stuff to buy, vehicles, things like that, not enough stuff to buy. And so now the Fed is having to come back because they didn't start to tighten up earlier on. They're having to really think about what they're going to do here. So that's where you've seen a lot of volatility. Yeah, with that, Jeremy is going to take over here in just a second. Ultimately, I think the Fed and their policies, it could be too slow and too fast. That's what we're concerned about right now, is can they get it just right? And if they don't, there are big consequences either way. Jeremy.
Yeah, absolutely. So that, I think, is kind of the forefront of, what everybody is hearing right now. You obviously feel it, inflation, right? And then you hear in the back of your mind, what's the Fed doing? Are they going to do it too fast? Not enough. Really, when we think about it, we think about Fed, and you always hear this in the media, right? Where they say, well, they printed too much money, or we need to take some money off the table. Like, how do they do that? So it's not this guy named Bill, in the back room who's, they yell back and, hey, we need to increase the money supply, Bill. And he, throws the lever down on the 20s machine and starts printing them out, right? No, they got some interesting things that they do. And primarily what they do is, they will either buy or sell US Treasury bonds, things of that nature, to banks. If they're buying them from banks, basically they're giving the banks cash. The amount of cash that their bank has, if it increases, they have the ability to lend more money to people. And thus, if people are being lent more money, then they have more money to spend. Really, 70% of the United States markets are people like you and me spending money, 70% of that. So if people like us have money to spend, that's a good thing for the market. But also, that's where if we have too much money to spend, maybe not enough goods to spend that money on, that's when issues start to happen there, right? The other one, of course, is interest rates, and we'll get to that here in just a minute. But, supply chain, Josh was talking about supply chain and whatnot. This is getting serious, people, because even the Quebec maple syrup producers, or the so-called OPEC of maple syrup, had to release about half of their total reserve. Now, I don't know what's more impressive here is the fact that there is an OPEC of maple syrup, or the fact that 22 million kilograms is only half of their emergency reserve. Also, the fact that Canada has an emergency reserve of maple syrup.
Yeah, that's important at my house, Jeremy. I don't know about you, but on Saturday mornings, Saturday morning is called Pancake Day at my house, and so maple syrup's very important to us.
It would definitely change the landscape of breakfast around the nation and in my house as well. Yes, definitely. But what we do see is, from 2021, the stock market really was, it was hard not to make money. Let's just put it that way. You can see on the slide, pretty much every section of every index, save for maybe bonds, was positive, and not just positive, but pretty big positive. So it was a tough place not to make money. Basically, the only place, of course, because bonds are at zero, it's really tough to make money in bonds. As interest rates increase from the Fed, that's going to be, again, kind of an ongoing issue. And so as we look kind of forward on this, if you go to the next slide there, Josh, we can see the different sectors. Now, this slide is actually a perfect example of why we own a little bit of everything. So during 2021, you could see, energy was a big performer. Tech was sitting there at number 2. Way down on the back, you can see utilities, consumer staples. If we were to look at this now, that yellow bar there for tech, that would be a lot closer to the right-hand side. That's dropped quite a bit. Energy is still fairly well up there. Financials, that third one, that gray bar, that is actually sitting in the number 1 spot right now. And both of the two on the far right, consumer staples and utilities, are actually closer to the middle as far as what we're seeing. So, sectors ebb and flow. This happens all the time, which is, again, pretty much the reason why we own a little bit of everything inside of there. When something's doing good, something else is going to do bad, and they're going to switch off from time to time.
Yeah, absolutely. That's one of the reasons why we want to, we always want to be diversified. Now, although diversification can seem a little bit boring from time to time, and I don't know, for those of you who remember the FANG stocks would be what Facebook, well, Meta, right? I guess now it's a different acronym, but Facebook, Apple, Google, Netflix, the kind of the usual suspects. But the FANG stocks, there was this temptation, or actually even this push for a while, a couple of years ago, that, hey, this is where all the money is being made. And so maybe you just need to invest in the FANG stocks. Well, that worked for a while, but you can think of how disastrous that would be when that sector pulls back, which it has. And we're in a correction right now, especially in tech stocks. Most people aren't comfortable with that ride. That would be a pretty rough ride. And those of you who are old enough, I'm old enough to remember the late 90s, right? And technology really was the hot sector, right? The hot area, especially .com stocks. How disastrous was that for people who were under diversified and said, we don't need energy, we don't need consumer goods, we don't need real estate. Well, the same thing happened a couple of years after that, right? Is that, well, now it's real estate. All the money should go to real estate. And people who put all their money in real estate, they weren't very happy when real estate had its bubble. So there's always a bubble someplace. Sometimes it's energy stocks. Any one of these sectors is going to have a bubble someday. So it doesn't cost anything to diversify. And although it's a more boring approach, that is one thing that you really are counting on us as your investment advisors to help you be disciplined and not get swayed when there's some voice out there that's telling you to get under diversified, put all your money one place.
Yeah, absolutely. So the key kind of thing to remember is that as we're shifting into 2022, we have to kind of keep an eye backwards. Overall in 2021, S&P 500 companies were profitable. So up about 45%. So that's a pretty big jump when we think about it. Now, if we are kind of looking forward, really what we're seeing is kind of talking about bloated companies. So I'm sure you've heard, is the S&P overvalued? What does this look like right now? If we think back to the early 2000s, S&P companies were earning about $1 in sales for every dollar that they held in assets, right? 1-to-1 ratio. Now, however, profit margins have dwindled a little bit. It's now earning just about 60 cents for every dollar. And so really what this suggests is the idea of asset efficiency. So companies learning to be more efficient with what they have and selling accordingly. basically, right? So they have to get better at producing. They have to lower their costs. They have to find efficiencies where they can in areas of shipping and just-in-time inventory, things of that nature. So this is kind of how we're seeing it moving forward, is that, again, just like Josh said, when things really hit the fan, what is it that the American economy does typically in the markets? They innovate. They find new ways of finding new efficiencies and doing things a little bit better to kind of keep pushing it forward.
Yeah, but I think overall it's a good point, because so many of our clients have actually worked in the tech sector. Many of you have been involved in things like this over the years. And you think about how many technologies we use right now that didn't even exist, a few years ago, or even a decade or 15 years ago, that really profoundly impacts the way we work. Think about what we're doing right now. For example, the Zoom call, really, it wasn't that long ago that the internet connections weren't even sufficient to do something like this, right? Where you could have literally hundreds or thousands or tens of thousands of people on a Zoom call at any one time. We're not quite to tens of thousands yet, but we'll get there.
Absolutely.
At least for our webinars.
Not yet. Yep. And so obviously the biggest, another huge thing going forward, and we see this every day, right, is the geopolitical standpoint of things. We could easily add on, China, Russia and Ukraine right now. That's kind of throwing in quite a bit of uncertainty in the markets. It does have some lasting effects as it's going, as it's over there. But really, this one's talking about China. And of course, China being a huge part of the world economy here. Their economic growth is slowing. They're seeing a lot more regulatory enforcement. The really kind of key thing that the market is seeing as far as China here is that kind of third bullet point down, Chinese companies delisting. And if we go to the next slide, overall, there's about $1.5 trillion of Chinese money and Chinese company in the New York Stock Exchange. That's a pretty big chunk, right? And in order to get on the New York Stock Exchange, typically companies have to, prove their value, prove their worth. They do this through financial statements. They have to do it up front, and then they literally have to do it quarterly every year, and then annual statements as well. Now, what's happening is Chinese officials are basically refusing to allow access to these Chinese company financials. And so the New York Stock Exchange is saying, hey, either pony up on these financials, or we are going to delist your $1.5 trillion of Chinese companies on here. So they've never in the past until now have really started withholding these things. They're calling them state secrets for all these Chinese companies. But it is an issue in listings of foreign markets. So that's definitely something to kind of keep an eye on as we're moving forward. We're not throwing a whole lot of money into Chinese stocks by any means at this point. But definitely, every portfolio has international holdings. So it's things like this that we kind of got to keep an eye on moving forward and see how it plays out. This is going to be an ongoing saga.
Yeah, and for anybody who's feeling left out, like, hey, I think I should have stuff invested in China. Believe me, you've got stuff invested in China. We all do, right? Global companies that we invest in or spend money at, there is a tie to China because they do the largest amount of manufacturing that we have right now. So many companies are intertangled, right? And you've got Chinese exposure, whether you know it or not.
Absolutely. Yep. And then, of course, bond yields. So this is the other kind of function of the Fed as well, or another tool that they use is interest rate increases. And so when we had given this, it was probably be a couple of weeks ago now, the Fed had just had a meeting and they had signaled that of the two things that they do, which is either buying or selling bonds back to banks and raising interest rates, they weren't going to raise interest rates just yet, but they did signal that they were going to stop buying more bonds and things from banks, and they were going to let whatever bonds they do have on the books mature, thus kind of taking more money out of the bank's hands. So when we talk about kind of tightening up Fed policy, they've already started doing the bond thing, right? They're not buying anymore. They haven't raised interest rates just yet. There is another meeting coming up here in about the middle of March where it's pretty well everybody's pretty much guessing that they are going to make some kind of interest rate hike, but we don't know exactly what that's going to look like yet. If it's going to be a quarter point, half a point, 3/4 point. Really what that last meeting suggested is, we know that inflation is real. We're going to start taking steps to pare it down a little bit, but we're afraid to get too aggressive too fast. And so, again, is that the right path? There's economists are split. Some say it's too little too late right now. Some say don't get going too fast. This is where the art form of the Fed really comes into play is, can they ride that line right down the middle where they're not pushing it too fast, but they're also not falling too far behind. As always, history will tell, right? History always tells and says, well, they should have done this sooner, or they went too far, they pushed too far. Typically what we'll see though, is we're going to see some interest rates rise. If history has anything to say about it, the Fed usually goes a little bit too long and gets a little bit too aggressive at some point, and then forces us into a bit of a recession, at which point kind of the market and the economy correct itself. And if we look kind of back to, 70s, 80s, after that happened, there was a pretty nice long period of up in the stock market. So watching those, but indefinitely, I think we're going to start to see interest rates rise. How fast and how far will yet to be seen.
Yeah, absolutely. And I think one of the things that's interesting on this chart as well is just the gray bars. You can see those are the recessions that we've had in the past. You can see we saw what kind of looks like a baby recession right in 2020, but you say, well, how was that a baby recession? It's because when you look at a couple of quarters of GDP growth, even if you're climbing out of a hole, that technically is the end of the recession. But I think the reality is that we all kind of feel like we're still in a recession because that's reality, right? The economy still has just barely gotten up to where it was pre-pandemic. And yeah, as far as the Fed, you go back and look at these other time periods, oftentimes the Fed does tighten too much. And often after a period of tightening, that is where you see the recession, as we can see there in the early 2000s, in the early 90s. And certainly a big one was in the late 70s, early 80s. We had a recession, but as Jeremy mentioned, that doesn't mean that the end of the story is bad. Oftentimes there's a big period of prosperity afterwards. And that's what we saw kind of after that early 80s recession. Really, for the most part, anybody who was invested in the stock market in the 80s and 90s, with the exception of a couple of hiccups in there, those were two pretty good decades to be in the stock market. So, and the same thing in the 2000s, after we got through the pain of the financial crisis that happened because of the real estate bubble, really, we saw the longest expansion that we had ever seen in economic history after that. In fact, we gave presentations. Jeremy and I have talked about this, right, pre-pandemic. In fact, I think it was the one right before the pandemic we talked about that, hey, we're in the longest expansion ever. And eventually things are going to go down. We don't know why. And of course, it was COVID, right, that happened right after that. But that's why this stuff is so difficult to predict, is that even with all the data and artificial intelligence and everything that we've got as far as tools now, still there's way too many factors, way too many unknowns to be able to be really precise about this. That's why even the Federal Reserve, that controls pretty large portion of the economy globally, even they don't get it right all the time. So we'll see what happens. About every 6 weeks or so they meet, and we're expecting that it's going to be a 0.5 point increase in March. But we'll see. There's a lot that can change. They look at other things too, right? They're always looking at the market, the economy. If, for example, knock on wood, let's say that there's an invasion, of Ukraine by Russia, and it roils the global stock markets, global money supply, I think you are going to see that the Fed takes a hard look at that and decides maybe we want to be a little bit easier. So these are the things that you don't want to bet on. In other words, these are things that you don't want to try to time the market based off of these things.
Absolutely. And they can change their mind all the time, right? The Fed, they can come out one time and say one thing, and then 6 weeks later come out and say the complete opposite.
They do. Yeah, exactly. How long ago was it? Not that long ago, where they were saying, well, inflation is kind of transitory. This isn't something that we really think is a problem. Well, clearly it's a big problem, and it's gotten to be a bigger problem because they didn't act sooner. So really overall, things can change very, very quickly, from extremely easy money policy now to what may be very tight money policy going forward. So there's a social media site, Buzzfeed. Anybody who does a lot of social media, I try to stay off of it as much as possible. But Buzzfeed, they actually did kind of a fun poll not that long ago about random acts of kindness, and they wanted to get some stories from people that had, kind of some stories of feel-good stuff that they had done. One of them was somebody who said, when I was a kid, I used to always twist the quarter machines on the way into quarters, or the way into stores, just in case. I remember doing that as a kid. Didn't get lucky very often. But once in a while, right, there was a toy that popped out. Now that I'm grown, if I'm leaving the store that has them, I like to drop change into them if I have it and leave them half twisted. Kind of a cool story. Another one, I put change in people's parking meters. I don't think many parking meters have change anymore. Most of them are digital these days, but so people don't run out of time, just doing something nice for somebody. And then I know a little boy in my child's class that lives a hard life. Whenever there's a raffle for any goodies, I buy a bunch of tickets and put his name on them. He's won a pizza party and an ice cream party. And how cool. And overall, I think those are just some fun stories, but overall, I think people are looking a little bit more altruistically about the market, about the economy. One big theme that really has been pushed pretty hard over the last few years has been ESG investing, which stands for environmental, social, and governance investing. What that means is that instead of just looking at the dollars and cents, it's looking at other factors, and there's lots of them. Sometimes this is also called responsible investing or sustainable investing or socially responsible investing or impact investing. This more or less means the same thing, but more and more investment portfolios and experts are looking to this to guide some of the investment decisions. The reason for that, number one, is to align investment strategies with their organizational values for whoever you're looking at, in other words, and values can be very different from organization to organization. To influence corporate behavior, you may have heard of that, activist investing. That's nothing new, but especially big investment portfolios sometimes can have some big sway over corporate decisions. To minimize headline risk, to, in other words, that kind of the politics side of things, to generate higher risk-adjusted returns. Of course, we always want to see that. Right? People don't invest in something because they don't want to make money. We want to make money. And then finally, to make a better world. And you'll notice that more and more portfolios and companies are incorporating this in their strategies. We actually do have an ESG only strategy for those of you who are interested, if that's important. The good news is that you can do it in a very cost-effective way now. In the early part of my career, now 20 years ago, it existed, but not very much. And if you invested in ESG type investments, they were really expensive and the performance was horrible. Now, not so much. We're actually seeing better performance and very, very low cost ways of doing that. So let us know if that's something that you want to talk about or somebody you know wants to talk about. So the business. Yeah, go ahead.
Yeah, and honestly, too, Josh, what we've seen is over the past couple of years, we've been seeing regular, non-ESG portfolios start to include ESG holdings. Yes. In them, just because those ESG holdings have been doing better than their non-ESG alternatives. So it's a really neat, it's an interesting kind of segue that they're kind of moving along, but I think it makes a lot of sense with, next generation coming up and having investable money and how they're choosing to do it, and just kind of a shift in the world of investing in general.
Yeah, that's a good point. I would say that it is definitely generational, especially Gen Z, very interested in ESG investing. As we're having conversations with people, we definitely have more people that are younger that are bringing that up as a topic. And it's great that that can be accommodated. Other thing to note is that ESG investing isn't at all size fits all, right? For some people, ESG means something different from somebody else. So that's something we can certainly talk about. The Business Roundtable survey found that CEOs expect the economy to grow by 3.9% year over year in 2022, which sounds great, right? If you look over the last 100 years, the economy more or less has grown about 3% a year. So that means above average. But again, we're still climbing out of the hole, right, of the pandemic. That's one big factor. The other thing to keep in mind is that if inflation is running at 6, 7, 8%, which that's kind of what's being reported right now, is that we're somewhere in that neighborhood of 6 to 8% with an economic growth of 3.9%. That doesn't sound so good, does it? It actually means that you're going backwards. So that's one thing to keep in mind, is that is why the Fed needs to act, and that's why they are going to act. Because if you've got stagflation, which is exactly what that means, it means your economy isn't growing fast enough to surpass inflation. If that happens year after year, as it did in the 70s, that's not a pretty economic picture. More or less, it means we're going backwards. People's standard of living is going backwards year after year. again, from the Business Roundtable, here are some of the concerns, the things that are coming up as far as the positives and the negatives. One of those is that companies expect to hire more employees if they can find them. Again, we talked about that before, is that business owners are having that as a struggle and oftentimes are having to offer better benefits, maybe increased pay. As Jeremy mentioned before, is that always a bad thing? No, 70% of the economy is us spending money on stuff, whether it be on vacations or cars or anything like that. So that actually can help in a way. Increased capital investment. That's an area that all the extra earnings that companies seem to be reporting right now is going to go to grow sales and then benefit from the Infrastructure Investment and Jobs Act. You might remember that legislation that passed last year. That money will not come out all at once, but some companies expect to benefit from that. And time will tell whether that ends up being a positive or negative economically. Some of the concerns, COVID-19, of course, is still here. This is not going away. Maybe it's never going to go away, but I don't know that it's going to have as big of an impact as it has really the last couple of years. Such a stark contrast from how we had operated before. And again, some of that's been good. Some companies have actually figured out more efficient ways of doing things because of COVID, because they were forced to change very quickly. I know for us at Keystone, most of our meetings, for better or worse, most of our meetings with clients right now are over Zoom calls. And I think it works for a lot of people, works out great, because if not, they would have had to have maybe a husband and wife are coming from two different sides of town. And even if they wanted to meet at the office, sometimes snow gets in the way, people get sick. Well, now we have very few cancellations in our meetings because you can kind of do this from any place, right? You can be on your phone, a tablet, at work. You could, just go outside and walk around. There's a lot of ways that you can get on a Zoom call. And so we're finding that that's a big efficiency pickup that we've had. We still love to see you, by the way. So if you want to come into the office, if you're in the neighborhood, please do that. But it has been an efficiency pickup, something that a lot of people have found very useful. Labor costs, again, that could be a challenge. It can be good because of maybe increased wages, people have more money, but labor costs could go up. And that also can drive inflation, because when a company has increased costs, what do? They don't want to just make less money. They want to pass it on to the consumer, right? So us as consumers, we're all having to pay more for stuff. And we're seeing that in a very big way right now with inflation. Supply chain issues, although that's starting to ease up, there's still a huge undersupplies in certain things, especially semiconductors, that will continue to be an issue. From some of our clients that work for chip companies, they're telling us that it's probably going to be years until we catch up, years, because many of the plants even that are being built, and some of these companies are spending tens of billions of dollars to build new chip plants, even here in the US. Those are going to take years and years until those come online and they get workers trained to be able to produce product. And then tax increases. That's one thing to keep in mind, is that even though we haven't seen any broad tax increases here recently, and there were some proposals, right, that we're going to see tax rates this year. We didn't see it pass. The Build Back Better plan would have changed the tax code fairly drastically. In fact, many people would have seen tax increases, but that doesn't mean you're out of the woods. If you look back to the legislation that was passed back in 2017, the Tax Cuts and Jobs Act, many of those tax cuts were not permanent tax cuts. They actually would phase out, and we're starting to come up to some of those years, right, where some of these tax breaks and tax reductions were going to be expiring. So keep that in mind. That's something we're going to be watching very closely, as well as legislation. So geopolitics, we talked about that. Ukraine certainly is on here. That's in the headlines every day right now. Can you make investment decisions based off of this stuff? Not really, because it's so unpredictable. If you made your investment decisions based off of geopolitical stuff, you'd probably never invest in anything. You probably would just leave your money sitting in cash forever, because there's always stuff like this going on. This might happen. Who knows? Maybe Russia invades Ukraine. Will it have a big impact on the market and the economy globally? Yep, it certainly would. But it also might not happen at all. Again, China could be another one that follows after that. There's always been, South China Sea, conflicts going on. That's kind of a back and forth between us and China. And then forced reunification with Taiwan. Of course, that would make a big difference as well, because you've got semiconductors primarily manufactured in Taiwan at this point. That's why such a big rush to create other manufacturing facilities around the world. And again, in the US, tens and tens of billions of dollars are already marked right now from companies that are building new plants. So lots of stuff that could happen. Cyber attacks, we could make a laundry list, right? This could be a really, really, really detailed long slide that has everything that could happen bad in the world. And some of it will. The bottom line is there is bad stuff that ends up happening. Sometimes it impacts the market, sometimes it doesn't. And sometimes it's stuff we didn't even think about. Like again, a pandemic, how do you predict that? So a couple of, we like smart people. We like to pay attention to some experts. A couple of smart people here at the end that are quoted. Overall, the BGRI shows a significant reduction in concern about geopolitical risk. We actually, at Keystone, we actually see that as a bad thing because if people don't have concerns, it's kind of like Warren Buffett's quote, you should be fearful when others are greedy and greedy when others are fearful. Well, if people's concerns are way down about geopolitical stuff right now, I see that as a little bit of a warning sign. But I think it's better to be fearful. In other words, when everybody else says, oh, everything is great, maybe time to think about that and at least have that in the back of your mind. In other words, it could be that the market hasn't fully priced in some of these geopolitical risks that could actually come into play. Excuse me. There are a lot of great technologies that are coming down the pike, and many of you guys are working on this, right, at your companies. And 3D bone implants and 3D organ printing in general, that stuff is coming right now. And even in 2022, right now they're predicting that there are 2 companies that actually will start using 3D printed bones and that it'll be widely available. So you think about that and then go another step and think about organ replacement. How many people have died as far as waiting for a kidney, being on these organ donation lists? If we're able to do this, and they think they can, they're actually quite confident that they'll be able to 3D print our own organs. There won't be any rejections, right? It's our own DNA. So there won't be any rejections and people won't have to be on waiting list to be able to get a new kidney or any other kind of organ replacement. So keep in mind that these are things that could just fundamentally change the game. It will change the game. Think about why people have died in the past and some of the technologies, the medical advancements that are coming that could cure major stuff like Alzheimer's, dementia, cancer. We've already basically able to, if we catch them early enough, most cancers right now are very treatable or curable. So just keep in mind that there are some good stuff out there as well, mostly with technology that will end up driving these solutions to problems. VR workouts. I don't know how many of you have been on some type of a virtual reality, augmented reality type of technology. Meta, they changed the name to Facebook, from Facebook to Meta, talking about the metaverse. So we're trying to wrap our minds around what that means exactly. But new VR headsets with fitness features are now coming out in 2022, full workouts, in other words, that you can do in virtual reality. To me, that sounds a little bit dangerous. We want to be a little bit careful, right, if we're running around and doing exercises with goggles on our face. But right now we laugh about it, but how many other things did we laugh about years ago that are now commonplace? So keep in mind that a lot of this technology stuff that we kind of laugh at and shake our heads like it's the Jetsons, it's stuff that could really have a profound impact in the future. Kind of a fun one here, virtual influencers. Technology is a lot of times cheaper than humans and more reliable in a lot of ways. So there's an interstellar traveler that's on its way, I'm told anyway, who's scheduled to arrive on Earth in 2022. And she already has a song that is out on a popular video platform. So kind of interesting. The stuff that's coming, again, we kind of laugh at it, but it could be things that are very commonplace in the future with virtual reality, augmented reality, and just technology advancements. So ultimately, where's the economy going? Nobody really knows, but we do have some guesses at least. This expert here, actually, we said before 3.9%, the Business Roundtable, as far as economic growth this year. This person's saying 4.5% this year. We're hearing numbers anywhere between 3 to 5% from most people right now, most experts. While we expect wage growth to slow a little in 2022, in the coming decade, a tight labor market could really be the norm. We think that's almost a certainty at this point that we're going to have a very tight labor market going forward. That's a good thing in a lot of ways because people can get jobs. We don't have to be in a really high unemployment situation where we have people that can't work. In fact, right now, I think a lot of the economic struggles that we're having is trying to get people back to work because many people retired early, or other people have figured out, hey, before we used to place a lot of value on maybe both spouses. If there's 2 spouses in the household, both spouses working full time, now one of them might be working part-time from home or not even at all. So a lot of situations have changed where people have either permanently or temporarily left the labor market. And then finally, macroeconomic backdrops that include slower growth and tightening monetary policy. This is from our friends over at Schwab. But really that the whole point here is that they're not recommending that people get out of the market. They're not recommending people get in the market. What they're recommending is discipline. And that's what really, I think, if anything, if you've got a great investment advisor, a great financial planner like us, is that we're going to be able to inject some discipline into the investment decisions that you're making. In other words, things that sometimes are very boring, like diversification and sticking to an investment strategy that works over time, really that can be a lot more beneficial to you as opposed to doing detrimental things like putting all your money in one thing, putting your eggs all in one basket. So we see that happen a lot. Unfortunately, over 22 years in this business, every now and again, I see somebody get crazy and they say, I'm going to put all my money into this one thing. Right now, it seems to be a lot of kind of new things like cryptocurrency or NFTs, more exotic types of investments. A couple of years ago, it was FANG stocks. A couple of years before that, maybe a few years before that was real estate and speculative real estate. And then before that was .coms, energy stocks. There's been a bubble, and there is right now too. I don't know what it's in exactly. Maybe it is crypto, maybe it's in other areas, but just know that there's always a bubble forming someplace. There's always an overpriced stock, an overpriced sector. The way we protect ourselves is diversification and being very careful about the risk level that we're taking in your portfolio. So with that being said, we're going to open it up for questions here in just a few minutes. We always want to open it up and leave a few minutes at the end for that. But just know that your team is here. We're here to help you from a financial planning standpoint, again, to make sure that your portfolio is right for you. The investment moves, the financial moves that you're making are right for you. That's our role as a fiduciary, and being certified financial planners, that is our role legally as well. We have to give you advice that's in your best interest. That's why you'd go to any financial advisor, you would think, but we actually have a legal obligation to do that. So keep that in mind. That's the highest standard you get in our industry, is a certified financial planner acting as a fiduciary. And we are fee only, meaning that we don't work for a big brokerage firm. We're independent, meaning that we work for you. We get paid by you. So ultimately, that's what we are looking at as far as our motivation. We do that in a lot of different ways. Comprehensive financial planning to us means kind of everything. And we brainstormed and came up with all these boxes, but you'll see that it's a lot more than the market. It's a lot more than investing. These are crucial decisions that oftentimes are irrevocable. When it comes to figuring out, when do I retire? When we go to figuring out, so maybe as a younger person, do I put into a traditional 401k or a Roth 401k? Do I need to get my estate documents done now, or can I wait? And the answer there is do it now. But a lot of these things that we dig into with your financial planning, these are just crucial as far as not only your life today, but untold impact on your spouse, your kids, anybody else that depends on you. So make sure that you are plugged into us. If you're not working with us right now, either work with us or work with another great financial planner that can help you make sure that your stuff is set up correctly and that your ducks are in a row. Whatever metaphor you want to use, we want to make sure that you are set and have a great plan. So with that being said, we've got our contact information here. We wanted to open it up for Q&A right now. Jeremy, what do we have?
Yeah, so please use that Q&A. It's at the bottom of your screen if you have any questions quick. Really, the one that we have right now, Josh, is around, you kind of hinted at it, crypto, what's our take on it? Are we using it in current portfolios, et cetera, right now?
Yeah, it's a great question. In fact, it's funny that question comes up because we actually did an interview that'll be posted as the podcast. For any of you who aren't listening to the podcast right now, you're really missing out. We have all of the old episodes posted, so you can go back and listen. But the easiest way to find the podcast is at wiserfinancialadvisor.com. So just go to that website. That will take you to our podcast page. So wiserfinancialadvisor.com. If you're saying what advisor, is it advisor ER or OR? It's both, actually. We got both URLs for that. So wiserfinancialadvisor.com. You'll see all the old episodes, but just be watching now because you're going to see one posted in the next week or so. My interview with Bill Barheit, who's the founder and CEO of Abra, which is a big cryptocurrency platform. And I'm not recommending everybody go out and start buying crypto or something like that. What we want to do is educate you. We want to make sure that you're fully informed on how this stuff works and what is cryptocurrency, because it is having a profound impact on the markets. We're not recommending that at this time to clients. It's just too darn volatile, a huge amount of volatility in that asset class. And most of the time clients are coming to us because they want us to reduce their risk, not increase their risk. So not to minimize it at all, it's having an impact on markets. We're watching it, but it's not something that we're actually recommending at this time that people put their money into.
Absolutely. And you know what? That's about it. We do have one on here. That's how is Keystone outpacing other financial investment firms? Talking about return on investment versus others.
Yeah, good question. I mean, everybody's portfolio is going to be a little bit different, right? We gear everything to a risk number. And for those of you who have been working with us for a while, you know that everybody has a risk number. That's from a risk assessment that each person takes. And that risk number is what we're basing your portfolio off of as far as how we build it, because we're trying to get just the right amount of risk for you with what you're comfortable with, and then trying to get as much return as we possibly can based on that risk level. So that's what we're measuring against, is off of your own individual risk score. Now, do we look at things like the overall markets as far as the S&P 500 and the Dow, and looking at how portfolios do relative to the rest of the market? Absolutely. We're always measuring that stuff, and we show you that during your financial reviews. But overall, most of our portfolios are based off of index funds or ETFs we use as investment vehicles. That doesn't mean we're restricted to that. We can use mutual funds. We can use individual stocks, bonds, real estate investment trusts, many, many things that are in our wheelhouse. But oftentimes we will be tracking broad markets and using the research that we've got in our own knowledge of your situation to build your portfolio.
Absolutely. Yep. And and that is pretty much it for the Q&A. And I think we are at time as well. So,
all right, great. Well, thank you for giving up your hour. We know everybody's very busy. Again, this is recorded. And so we have a recorded version of this that's going to be out there here very shortly, probably by the end of the day on our YouTube channel. Easiest way to find that, just go to keystonefinancial.com. Up in the upper right-hand corner, you'll see our social media links. And by clicking on our YouTube channel, you'll see our archive of past presentations as well as this one. Always want you to share this as well. Any family members, friends that couldn't listen to it today, make sure you pass this on, because ultimately that is our goal in doing these educational events, is making sure that you're fully informed, you have the ability to ask questions, but also we know there's a lot of other people out there that we don't work with that hopefully they'll become clients as well. But really, I think right now we're so much short on wisdom out there. There's a gazillion pieces of information, right? And it's all contradicting itself. So I think that's why there's so much confusion in the financial world right now. So we're kind of starving for wisdom, and we recommend that really you tune into our stuff, because we really try to cut through all of that and really encapsulate it with how it applies to your financial life. So with that being said, though, I really appreciate everybody being on here today. Thanks for joining us. For those of you who are clients, thank you for your business. For those of you who are not clients, thank you for your future business. And we hope you have a great day. Take care.
Everybody have a good one.